Welcome back. After 2 straight years of big gains on U.S. stock markets, what can investors realistically expect in 2025? Our next guest believes the mega-cap tech stocks deserve the high multiples they're trading at, and as such, he believes double-digit stock market returns are possible in 2025. Let's welcome Barry Schwartz to the program. He, of course, is Chief Investment Officer at Baskin Wealth Management. Barry, thanks a lot for coming in.
Thanks for having me.
You're constructive on stocks in 2025.
I'm very constructive. I think what worked in 2023 and 2024 will continue to work again in 2025. And Paul, I believe that's all due to earnings.
The concern among people who are more cautious and worried is that multiples have gotten to the point where earnings performance has to be very, very strong. What's your take on that?
And that's an absolutely fair point. If you were comparing the market today to the market of 30 years ago, when the companies that dominated the S&P 500 were oil companies and banks and utilities and car companies that are cyclical and deserve to trade at very low multiples of earnings. These are not those companies today. These are companies, the mega caps that have gigantic profit margins that are growing, fast-growing earnings, revenues, global platforms. These are not cyclical businesses of the 1990s. And as a result, in our opinion, they deserve to trade at higher multiples. They deserve to trade at 20, 25, 30 times earnings because of their fast growth over the coming years. And that's why we think it's not reasonable to compare the high multiples of today to years ago.
So you're talking about the Mag 7 here.
Yes.
That's a very small number of very large tech companies, correct?
If you look at the 8 of them, and that now includes Broadcom, I think they represent over 40% of the S&P 500. And those are all 8 of those companies are expected to grow earnings by double digits in 2025. A number of them are expected to grow by 20% or 30%. Amazon, Tesla, Broadcom. They're going to drive the earnings of the S&P 500, and they deserve to trade at high multiples as a result of the growth. And for some of them, they're just getting started with some of the potential future tailwinds, whether it's autonomous driving, AI, quantum computing, robotics. These are such huge markets these companies are getting into, and they have all the products and services to benefit from those tailwinds.
What is your positioning like on behalf of clients in those mega cap techs?
Well, we always like to lean towards more value-oriented companies. So our holdings are Google, Meta, Microsoft, Amazon, and Apple. We don't own NVIDIA, we don't own Tesla, we don't own Broadcom, but we're looking at those companies all the time. The valuations right now are a little bit too high for us to get excited about them.
Do I understand correctly you own Adobe?
We also own Adobe.
Right. Now that's a big tech player that has not, the stock has not done well. It sold off in a big way on some guidance recently, but a lot of portfolio managers say this also is an AI stock.
Absolutely. So Adobe had a really bad year stock-wise. The earnings came in fine, and the earnings guidance that it gave for 2025 are for double-digit earnings. So the market is really worried about all these new AI technologies that may disrupt the editing tools for Adobe. We take a contrarian view. We think that Adobe offers so many tools, and as AI continues to grow, it will unlock more demand for Adobe's services. That's always been the case in the past. We think Adobe is a great contrarian pick here for 2025.
What about other sectors of the stock market, non-tech tech sectors of the stock market?
Well, we're very interested in Canadian companies, but more those that are focused on being serial acquirers like Constellation Software, First Service, Waste Connections, Restaurant Brands in Canada. We like great businesses run by strong management teams that know how to add value with acquisitions.
One stock that's on the board there that I don't think you've mentioned yet is Couche-Tard. It could be a very interesting 2025 for Couche-Tard. There surely will be a resolution of its pursuit of 7 and I, the parent of 7-Eleven in Japan. What are your thoughts on that situation? What it means to shareholders?
Oh, absolutely. I think a lot of shareholders were worried that Couche-Tard was going to blow its brains out making this acquisition, maybe taking on too much leverage, doing too much equity issues. One of the reasons why the stock has underperformed, Paul, in 2024 is because of exposure to low-income consumers that have been trading down on drinks and food and cigarettes. We think some of those issues will reverse in 2025. I don't think Couche-Tard is going to pursue a full acquisition of 7-Eleven. It may wait for maybe a potential spin-off, make acquisitions then, as well as also looking at making other acquisitions in the United States in 2025. One thing that investors need to consider is Couche-Tard generates an enormous amount of free cash flow. We think it's going to restart its buyback, and that should help put a floor under the stock.
The stock, like Adobe, did not have a great, or has not had a great 2024. Is that because of the concern about Japan?
I think that's part of the reason. The also reason was the earnings were not strong in 2024. I think they've taken a number of steps to rectify that situation, and they already mentioned in their last earnings conference call that results were improving in October and November.
Are you concerned about the path of the Canadian economy and its effect on Canadian companies that do most of their business here?
Absolutely, we are. And many Canadians should be very worried about the upcoming Trump presidency and the potential concerns about the implementation of tariffs. We don't know how that's going to play out. Obviously, it could be very impactful to the Canadian economy. At the same time, the Canadian economy is not doing very well compared to the U.S. economy. As you see with the Canadian dollar, that represents, it's the stock price of our country. And that stock price is going in the wrong direction. And obviously, with a lower stock price, that's going to make us importing food and other important goods all that much more expensive. In the meantime, the Bank of Canada was very slow to cut interest rates.
And so with that in the background, what's your view of the Canadian bank stocks?
Well, the Canadian bank stocks are going to benefit, of course, by the drop in the interest rates. One of the worries that we all had was interest rates being high in 25 and 26. That would hurt mortgage payers, but that seems to be reversing. And the Canadian banks have lots of exposure now, Paul, to trading, wealth management, more fee-generated business. So we're mildly positive on the Canadian banks. They had a great run. Obviously, a lot of the underperformers did great in 2024. Bank of Nova Scotia, Bank of Montreal. We think they're okay investments heading into 2025. I wouldn't be jumping up and down buying them.